Gold and silver aren't going up. Your money is quietly worth less. That sounds like another market cliche, but here's the contradiction hiding in plain sight. Prices look like a speculative run. Charts scream overbought. And yet, since 2020, the money supply expanded by roughly 40%. That's not sentiment, that's math. And it means the unit you measure everything with has already changed. This matters to you because if prices are resetting instead of inflating, then waiting for the old numbers becomes the most dangerous bet in the room. Assets don't crash back to yesterday when the currency itself can't go back. They reprice permanently. This isn't 1980. There's no single villain, no cornered market, no mania to burn out. What's happening now is quieter, slower, and far harder to reverse. The system underneath pricing has shifted, and once you see that, the story stops being about metals. It becomes about what happens when the baseline breaks. What happened next didn't arrive all at once. It surfaced through a single market that almost nobody was watching. Quietly, yields on Japan's 30-year government bonds jumped more than 8% in a single session. That kind of move doesn't happen in stable systems. It happens when control slips. Japan isn't a small player. Its debt-to-GDP ratio sits above 200%, and it holds over $1 trillion in U.S. treasuries. That makes this more than a local problem. Here's the partial picture most headlines stop at. Inflation pressures rise. Central banks get boxed in. Bond markets react. But that's only about 60% of the story. The rest sits in what Japan may be forced to do next. To defend its currency without printing more yen, liquidation becomes an option. And not just any assets, U.S. debt. Now pause on that. If the largest foreign holder of U.S. Treasuries starts selling into a market already straining to absorb issuance, yields don't drift, they gap. So the real question isn't whether this is volatility, it's whether this is the first crack in a market the entire global system leans on. Here's the claim that changes how this entire story reads. The pricing of silver and gold is no longer being set by speculation. It's being set by scarcity colliding with a permanently expanded currency base. The evidence starts where most people never look. Since prices were suppressed for years, investment into new mining dried up. According to the data, roughly 75% of global silver supply now comes as a byproduct of other mining operations. That means silver isn't mined because demand is strong. It's mined only when copper, zinc, or lead projects happen to make it. And those ore grades are deteriorating. In many cases, yields struggle to reach 100 grams per ton. Now contrast that with what's rare. High-grade primary discoveries still exist, but they're geological outliers. Intercepts like 467 grams per ton over 15 meters don't represent abundance. They highlight how little high-quality silver is left. Notice what's missing here. There's no fast supply response, no switch that gets flipped when prices rise, because the easy silver was already mined years ago when prices were artificially low. And here's where the story flips. Unlike gold, silver isn't hoarded, it's consumed. Electronics, energy systems, industrial processes. Once it's used, it's gone. So when demand rises in a system that can't replenish supply quickly, prices don't spike. They re-anchor. And that sets up what comes next. This is where the situation stops being theoretical and starts to normalize something that shouldn't feel normal at all. Rising prices used to signal excess. Today they're signaling strain. What we're watching now looks less like a classic commodity cycle and more like a slow-motion replay of past monetary breakdowns, except stretched across multiple markets at once. Not one spike, not one crash. A layered failure. Look at what's becoming routine. Governments running debt loads that would have triggered crises decades ago. Central banks pinned between inflation and solvency. bond markets moving with the kind of volatility usually reserved for emergencies. And instead of reversing course, the system adapts to it. Higher yields, larger deficits, more currency creation to hold everything together. This is where the story flips. What once would have been treated as a warning is now absorbed as background noise. A 40% expansion of the money supply isn't framed as extraordinary. It's treated as done, locked in, the new starting point. And in that environment, assets tied to physical reality stop behaving like tradable instruments and start behaving like constraints. You can't print more ore, you can't accelerate geology, you can't unwind decades of underinvestment overnight. So when prices rise now, the question isn't how high is too high, it's why the old levels ever made sense in the first place. And that normalization sets the stage for a far more uncomfortable contradiction next. Now the evidence gets harder to ignore because the words and the actions stop matching. On paper, silver still trades as if it's abundant. Spot prices imply flexibility, liquidity, easy exit, but on the ground, the physical market is telling a different story. Coin shops across the US are suddenly overwhelmed with selling pressure, not because demand vanished, but because the plumbing broke. Dealers who were paying $5 back of spot moved to $10 back almost overnight. Same metal, same day, completely different reality. Here's the contradiction. In a true bubble, liquidity expands as prices rise. Instead, liquidity is vanishing. Shops are becoming over-leveraged with metal and undercapitalized with cash. They can't move inventory fast enough. And upstream, refiners are the real bottleneck. Major refiners have begun rejecting 90% silver entirely, junk silver, sterling, alloy. They don't want it. Notice what that means. This isn't about value collapsing, it's about capacity failing. The system can't process the volume, so spreads explode, buybacks collapse, and retail holders discover that spot price doesn't mean what they thought it did. This is the line that permanently reframes the issue. A market can look liquid on screens while being functionally illiquid in the real world. And once that happens, price stops being the signal. Flow becomes the signal. And that's where pressure starts to compound. Now watch how fast this stacks. While retail liquidity breaks down in the West, pressure is building somewhere else entirely. In Asia, physical silver is trading at a premium. On the Shanghai Futures Exchange, prices sit $8 to $12 above Western benchmarks. That's not a rounding error, that's a split market. Same metal, same ounce, two different values depending on where you stand. At the same time, sovereign behavior starts shifting. India's central bank moves to allow silver as bank collateral, placing 10 kilograms of silver on equal footing with 1 kilogram of gold. That ratio doesn't come from traders, it comes from policy. And it quietly signals that silver is no longer being treated as a disposable industrial input. Then add a third pressure point. Governments begin classifying silver as a critical mineral. Not symbolic, strategic, direct state interest replaces passive regulation. Capital doesn't wait for price confirmation when national supply chains are at risk. Free developments, free directions, all accelerating at once. Western liquidity freezes. Eastern demand pays premiums. Sovereigns move silver closer to money. This isn't coordination, it's convergence. And when markets move faster than infrastructure, something always gives. So ask the uncomfortable question, what happens if this continues? Now bring this back to you, because this is where it stops being abstract. When systems like this strain, the impact doesn't show up first on balance sheets. It shows up in delays, higher costs, and fewer choices. Electronics get more expensive. Energy projects miss timelines. Manufacturing margins tighten. Not because companies are greedy, but because one critical input becomes harder to secure at any price. If you're holding savings in cash, the risk isn't a sudden crash. It's slow erosion. Each month, The same income buys less stability, less optionality, less time, and if you're holding assets you assume are liquid, this market is already warning you that liquidity is conditional. It exists until it doesn't, and when it disappears, it does so unevenly. Here's the part people feel, but rarely articulate. This isn't about getting rich off metals. It's about the cost of not understanding what's changing underneath the economy you live in. When infrastructure breaks, everyday people absorb it first through prices, shortages, and stress. If this feels familiar, say so in the comments. Others are noticing the same pressure, because the bigger question isn't whether this affects you. It's how prepared the system really is when more people start asking why. Here's the part mainstream coverage almost never touches because it doesn't fit into a headline. This isn't chaos. It's incentives doing exactly what they're designed to do. The system rewards leverage, speed, and scale, not resilience. Paper markets grow because they're efficient. Physical systems shrink because they're expensive. And for years that imbalance looked harmless, until it wasn't. When price discovery lives in futures markets, the signal favors volume over availability. Contracts trade hands thousands of times without metal ever moving. That works until physical demand asserts itself. Then the system doesn't break loudly. It clogs. Refiners prioritize purity, dealers ration cash, sovereigns bypass markets entirely, and secure supply directly. Here's why that detail changes everything. Once states and industries treat a material as non-negotiable, price stops being a deterrent. It becomes a gate. Whoever can pay passes, whoever can't adapts or exits. That's not speculation, that's triage. This is how power expresses itself in late-stage systems. Quietly through access, through priority, through rules that don't announce themselves but reshape outcomes. And once incentives flip from efficiency to security, markets don't return to balance. They move to control. And that's when the next move starts forming. From here, the path splits, but neither direction goes back to how things were. One path looks controlled, at least on the surface. Prices continue rising, but gradually, governments intervene directly. Strategic stockpiles grow, supply chains get prioritized, silver and gold settle into officially higher ranges, not because markets demanded it, but because institutions absorb the cost to avoid disruption. Volatility stays, but it's managed. The system bends. The other path is faster and messier. A shock lands, a bond market breaks, a trade dispute freezes capital, physical shortages surface publicly instead of quietly. In that scenario, price doesn't adjust in steps, it gaps. Liquidity vanishes first, then confidence. Policy reacts after the fact, not ahead of it. What matters is that both paths share one assumption: the old baseline is gone. Whether the transition is smooth or violent, the direction is already set by debt scarcity and incentive alignment. Notice what nobody credible is arguing anymore. There's no serious case for a return to pre-2020 conditions. The debate is only about speed, and speed is rarely something systems get to choose. Because the next move isn't announced, it reveals itself. There's one insight that ties all of this together, and it's easy to miss if you focus only on prices. This story was never really about gold or silver. It's about what happens when trust shifts from systems to substance. When currency expands faster than reality, when supply chains thin instead of strengthen, when institutions quietly signal what they're preparing for, value stops being abstract. It becomes physical, strategic, scarce. What you're watching isn't a rally, it's a redefinition. Markets are relearning the difference between what can be promised and what can actually be delivered. And once that distinction matters again, everything reprices around it. That's why this moment feels uneasy instead of exciting. Because resets don't ring bells. They just move the floor while people are still standing on it. If you want to understand where this goes next, how policy, markets, and real-world constraints collide from here. Stay with this channel. The next layer of this story is already forming, and it won't wait for consensus. Follow for the analysis. Most people only realize after the shift is complete